Hello and welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. With so many ways and means of investing, where do you even start? If you ask me, the stock market is a great place to start. You can start investing very little money and grow from there. What is the stock market? Simply put, it is a marketplace where company shares, also known as stocks or equities, are bought and sold. The stock market provides a venue where companies raise capital by selling shares of stock to investors. Stocks give shareholders voting rights as well as residual claim to corporate earnings in the form of capital gains and dividends, which I will explain further later on in the video. Individual and institutional investors come together on the stock market to buy and sell shares in a public market. When you buy a share of stock on the stock market, you are not buying it from the company. You are buying it from an existing shareholder. Owning stock means that a shareholder owns a slice of the company equal to the number of shares held as a proportion of the company's total outstanding shares. An individual or entity that owns 100,000 shares of a company with 1 million outstanding shares would have 10% ownership stake in it. Since the stock market is a secondary marketplace, you would need to have a stockbroker which acts as a middleman that you would use in order to buy and sell your stocks. Which one you use will depend on whether or not you want to be hands-on with your investments. Banks and other financial institutions can manage your account for you, but it will come at a price. If you want to take control and do it yourself, then I recommend using Easy Equities, which is an easy-to-use investing platform that allows you to buy fractional shares. The link to it will be in the description box below. If you are interested in signing up, then use the link in the description and you will get a 50 Rand bonus to get you started on your investment journey. So how do you earn interest on your money invested? The idea is to buy low and sell high, but it's not always that simple. With 11 main business sectors consisting of energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, utilities, and real estate. It is important to take the advice of the greatest investor known to man, the one and only Warren Buffett, who has made millions of dollars for himself and shareholders in his company, Berkshire Hathaway, which is one of the biggest conglomerates in the world. Here are some of his tips. Number 1, never invest in a business you cannot understand. This is very straightforward. If you are not clear about what the company is doing, then you don't know enough to invest your money in it. Number 2, if you aren't thinking about owning a stock for 10 years, then don't even think about owning it for 10 minutes. A long-term approach to investing is the only sensible way of making long-term gains. A classic example of this is Warren Buffett's holding in Coca-Cola, which he has held from 1988 and has added to it and is now currently worth 9% of the company. And this helps him enjoy great returns from it each and every year. Number 3, diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. The idea of not putting all your eggs in one basket is known as diversification. Warren believes in owning a few quality stocks than many mediocre ones. It's good to have a few quality stocks, but having too many will spread your money too thin. Number 4, remember that the stock market is manic depressive. You don't have to react to everything that happens on the stock market. The news you hear most of the time are mostly just noise that excites people or causes them to panic over things of little to no significance in the long term. Number 5, You don't need to become a rocket scientist. Investing is not a game where the guy with 160 IQ beats the guy with 130 IQ. You don't have to be super smart or have some fancy algorithm for you to understand what happens on the stock market. Number 6. Price is what you pay. Value is what you get. It is important to focus on the value of the company instead of just looking at its stock price. Short-term results are not an indication of future performance and returns. Number 7. Investing in the stock market is not a path to get rich quickly. Do not invest money in the stock market in the hope that it will double or triple in the next 3 months. That's more of a gamble than an investment. You can't predict the market. With an understanding of everything discussed so far, it is your duty to apply yourself to getting educated about the stock market, and one way of doing so is by subscribing to the channel and turning on your notifications so you never miss a video, and by clicking on the like button to show your appreciation for all the work that goes into making these videos. Other than company shares, you can also get access to index funds, which are like a portfolio you buy into that contains a number of companies depending on what the focus of the fund is. When you buy into the fund, you're actually buying up fractions of different companies. When you spend, for example, 100 Rand, it gets split into fractions that all go towards certain companies. The idea is that you will get the average performance of all those companies grouped together. The most popular of all the index funds is the S&P 500, which tracks the top 500 companies in the United States under one fund. This fund has an annualized rate of 7% over the past 20 years, which is more than what most people will achieve. The most popular index fund in South Africa is the Top 40 Index, which tracks the top 40 companies listed on the JSE, the South Africa's main stock exchange. There are a few drawbacks when it comes to index funds. They come with a minimum amount for you to get started. They have a bit of an expensive annual fee and aren't available on a platform like Easy Equities. Fortunately, there is an alternative in the form of exchange-traded funds, or ETFs. They track index funds like the S&P 500 and the top 40, but behave more like stocks, which means you can also buy them in fractions. Another added benefit is that they have a very low annual fee and are available on all platforms. ETFs are very important, and you'll see why as we continue learning about the stock market and its component in future videos. One of the most important things you can do to make the most of your investments is to keep adding to them. And the easiest way of doing so is by consistently investing the same amount over a set period every time, thus making it a habit. This is known as dollar cost averaging. This is a proven strategy that is very hard to beat. So why should you invest in stocks? Because they are one of the best performing asset classes around. Remember how earlier on I mentioned that businesses raise money through the stock market? Well, when the businesses do well and their stock prices increase in value, it also increases the value of your holdings in those companies. This is what is known as a capital gain. Some companies will pay their investors from the profits that they have made. This is what is known as dividends. They are paid out at different times depending on what the company decides on. So it could be annually, biannually, quarterly, or even in some cases, monthly. This is money that you can choose to either reinvest into the company, thus growing your holding, using it to buy up stock in another company, or withdrawing it as income. My recommendation would be to reinvest it. We've talked mostly about all the positives about the stock market, so let's look at some of the negatives. First, there's risk involved because companies can go bankrupt, but the chances of that happening to a good quality company are very low. On the topic of risk, not taking action is the biggest risk of them all. You will learn nothing and you will gain nothing. Market volatility is a reality. The market works in cycles, and you will therefore have downturns from time to time. This is actually not a bad thing. When stock prices are down, they are actually cheaper to buy. So now that you know a little bit about the stock market and how it works, it's time to take action and start investing if you have not done so. Don't forget to use the link in the description below to sign up and get that 50 Rand bonus. Remember to subscribe to the channel and turn on your notifications so you can continue learning more. Thanks for watching. Hope to see you on the next video. But until then, stay invested.